All right, today we are prying open one of the most secretive, most powerful black boxes in all of finance, the hedge fund. It's this world of just staggering wealth, kind of shadowy strategies, and a completely different set of rules for a very, very select few. So let's dive right in.
The whole thing starts with a huge paradox. The entire idea of a hedge fund was originally invented for protection, for safety. So how in the world did it turn into this exclusive, high-risk casino for billionaires? That's the puzzle we're going to piece together today. So, you see, back in the 1950s, a guy named Alfred Jones came up with this idea. And to hedge just meant to protect yourself. I mean, think of it like buying travel insurance for your investments. He'd buy some stocks he thought would go up, but at the same time, he'd bet against other stocks he thought would fail. The whole goal was just balance. Fast forward to today, and that simple, safe idea has been twisted into its absolute polar opposite.
Now, to really get how this happened, we've got to jump in a time machine. The key that unlocks the entire hedge fund universe wasn't cooked up by some Wall Street genius. Nope, it was actually an unintended consequence of laws that were passed way back after the Great Depression.
So picture this. The 1920s were, well, a wild time. Investing was like the national sport, and people were borrowing money left and right to buy stocks in companies that sometimes didn't even exist. There were basically no rules. And then, in October 1929, the party came to a screeching halt. The market crashed, kicking off the Great Depression. So, to stop this from ever happening again, Congress stepped in and created the SEC to enforce some rules of fairness and transparency.
And here's the absolute crucial point from all that. These laws were designed to protect the average person by creating a single public market. The big idea was that if everyone had the same verified information and every company had to be transparent, then nobody could get an unfair advantage.
Which, brings up a pretty interesting question, right? If the public markets are designed to be this level playing field, how do the ultra-wealthy find an edge? How do you get ahead in a game where everyone is supposed to be playing by the exact same rules?
Well, you don't play that game. You find a different one. And this right here, this is the key. Hedge funds operate in the private market, and you can only get in through this legal loophole created for the accredited investor. The logic of the law is kind of simple. If you're rich enough, you don't need our protection. You're considered sophisticated, so all those rules about transparency and fairness, they just don't apply to you. This is the legal backdoor that creates an entirely separate private universe of investing.
So what does it actually look like inside this private world? Well, once you step through that door, the game changes completely. And honestly, the best way to think about it is with an analogy.
Okay, what's so great about this slide is how perfectly it frames these two worlds. The public market, it's like a crowded fishing dock. The water's pretty clear, you can see what everyone else is doing, and it's relatively safe. A hedge fund, on the other hand, is a submarine. It's a small, highly trained team diving down into deep, dark waters nobody else can even reach. Their moves are totally hidden, and they're hunting for things that no one on the dock even knows exist.
And believe me, the toolbox they have on that sub is something else. Hedge funds can do things that are strictly forbidden for regular funds. They can borrow huge sums of money, use these super complex instruments called derivatives, which are basically side bets, and they can even bet against entire economies. They invest in things you would never, ever find on a stock exchange, like private loans to companies or even rare art.
And if you're an investor, the journey is just as murky. You hand over millions of dollars to a manager who pretty much says, "Trust me," and then disappears. There are no public reports, no daily updates, and your money is often locked up. You can't touch it for a year or even longer. You just have to cross your fingers and hope they come back with more than they left with.
Now, for taking on all this risk and agreeing to all this secrecy, you'd think the rewards would have to be incredible, right? But that brings us to maybe the most controversial, most mind-blowing part of the hedge fund world: how the managers get paid.
And let's be absolutely clear about this. The system is structured till the manager makes a fortune, often whether their investors do or not. It is heavily, heavily skewed in their favor. So let's just run some simple numbers to see how this works. Imagine a pretty standard hedge fund, and they're managing about $1 billion.
This is the famous, or maybe infamous, 2 and 20 rule. The 2 is a 2% management fee. On a $1 billion fund, that's $20 million a year, guaranteed. It's their salary, and they get it even if the fund loses money. The 20 is a 20% performance fee. So if the fund makes a $100 million profit, the manager pockets an extra $20 million, leaving the investors with the other $80 million.
And this table just lays it all out, crystal clear. The investor?
They take on all of the downside risk. If the fund tanks, that's their loss. The manager, meanwhile, gets a guaranteed multi-million-dollar income, and they get a huge cut of the profits if things go well. It's basically heads they win, tails you lose.
Which leads us to the billion-dollar question. I mean, in recent years, a lot of hedge funds haven't even managed to beat a simple, low-cost S&P 500 index fund. So why on earth would the smartest, wealthiest people on the planet agree to these insane fees, the total secrecy, and all the risk for what are often just mediocre returns?
And the answer is they're not just buying an investment, they're buying a membership to a very, very private club. Because the investment itself isn't really the point. It's about gaining something far more valuable, something you just can't get in the public market. And this is it. This is the hidden value. It's about access. Access to strategies and private deals that you and I will never even hear about. It's about networking with the other powerful investors in that fund. It's about status. Being an investor in a top fund is a badge that signals you are in the inner circle. And yeah, for some, it's just the convenience of it all, like hiring a private financial chef to handle everything. This quote just captures the entire idea perfectly. It's not really about what happens inside the fund. It's about being invited into the room. Because that room is where you hear about other opportunities, where you make the connections, and where you become part of the ecosystem where real wealth is made.
So we really come full circle, don't we? What started out as this really clever way to reduce risk has evolved into something else entirely. A parallel financial universe, one that operates under a totally different set of rules, built exclusively for those who can afford the steep price of admission.
And that really is the main takeaway here. It's not just that there are different investment strategies. There are literally two different worlds in finance. You've got the public market, which was designed to be safe and transparent for everybody, and then you've got the private world of hedge funds, which exists for a very, very different purpose.
And that just leaves us with a final thought to chew on. We usually think of luxury as, stuff, things you can buy. But maybe, in the world of extreme wealth, the ultimate luxury isn't something you can own, but a room you can get into, a secret you get to hear, and a game you get to play. Maybe the ultimate luxury is just access.